Okay, so we're beginning with group accounts, a question. Now, this question is a tutorial question. So it has a few adjustments. But these adjustments, they are there to just help us see how we can progress to other complicated questions. But it's a very, very good question for group accounts. So there we go. I'm going to share this question with you. And that's the question. Yes. Okay. Are you able to see the question?
No. Screen is black.
The screen is dark.
Okay, the question is there now.
Okay, you can see the question.
Yeah.
Okay, so that's our question. Now, this question is a group accounts question. It's the ACCA question. Yes. Now, in group accounts, I want to mention that they are just things that you must be able to know as a student to understand group accounts. Take, for example, there is a goodwill in group accounts, which you must just be able to know that this is goodwill. There's goodwill, there's NCI, there's group structure, and there is other calculations which you must be able to know to build up to the financial statement. But for me, I find it easier to first begin by getting the free marks. Once you get the free marks, you post them, then you can come back and start building your answers now, from the group structure to a net asset list to goodwill to NCI, then to group retained earnings, and then you can go to investment associate after you've done the free marks first. But some students, they start with the workings and then they start posting later. So that one is also okay, but I find this one to be very fast, where you post the free marks first before you read any note. Just get the free marks and post them, because the group accounts does not change. The principle is always the same. So we are going to first post the free marks, and then we'll come back and do the workings, the group structure, net asset list, goodwill, NCI, group retained earnings, then investment in associate. So now I want to take you to the whiteboard, and then we're going to post. So the idea is group accounts, the format. Before you read any note, because all these notes that you're going to sit down, they are not notes which are going to be independent of what you're going to do. So look at it this way. Let's say this is our format right there. Okay, that's our format. And as well, first things first, you need to know the requirement before you begin to post, because you can start posting unnecessary things. You see, we've been told to prepare the consolidated statements of financial position. Have you seen that? For this guy. Okay, let me just turn off my WhatsApp. The student from the other WhatsApp group is texting, so to avoid disturbed with these messages coming in. Okay. Let me just turn this one off. Are you able to see the message?
Message.
Okay, all right. Okay, there's a message from WhatsApp which has appeared on my screen. Yeah, okay, there we go. Okay, are you able to see this question?
Yeah, I can see the question.
Okay, so that's our question right there. Prepare a consolidated statement of what? Of financial position. So our question, financial position for the end of December 2009. This one is important because it helps us with depreciation this year. Yes, this year is important because of depreciation. Okay, so it's important to know which year you're preparing accounts for. So now, as I mentioned earlier, but we want to go with the free marks way. So the free marks way, there we go. We're going to simply put a line here. We'll just put a line here. And once we put a line, what we're going to do, we're going to isolate this guy, the associate. So the associate is going to be isolated. We're going to deal with the parent and the subsidiary first.
Subsidiary.
Now, as I mentioned, group accounts format is the same, don't change. The same way the question comes is the same way the format is. So simply copy and paste this format into the answer sheet and start posting free marks. Now, how do you post free marks? So simply get the figures for the parent and for the subsidiary, add them. 220 plus 160. 230, that's investments in associate. Now that one, you don't want to add anything. You want to wait until you do a working. There's a working here. Are you seeing that? And then you come to inventories, current assets. You've got inventories, this plus this. This guy plus this guy. This guy and this guy. You know, it's always the same, and the show goes on. You come to equity. Equity, we said we always pick for the parent. This guy.
Just one question.
Okay.
On inventory and if there's an issue of intergroup trading.
Intergroup trading. Okay.
How does that? So we do adjustments after adding, or what?
Okay. So here what's happening is that we have a note. One of the notes here is on intergroup trading. So we are going to do with intergroup trading in this question.
Okay.
So no problem, don't worry, it's coming. We have a question on intergroup trading. So one of the notes intergroup trading. So we are going to discuss it.
Okay.
To discuss. Okay. So let's continue. After there's a student who asked a question on intergroup trading. His name is, I told you that I was going to tag him in the question.
Yeah.
He was asking how to calculate annualized profit. Paul Manda Jr. Yes, from Facebook. Paul Manda Jr. He asked a question how to calculate annualized profit. So I think I will tag him after this one is done so that he can also be able to see. Okay, so what happens is that here we said we pick for the parent. And then we come to the share premium. Share premium, see? What do? There's a working here. You see it? Yes, we are going to leave that one the way it is. We don't want to temper. And then what else do we have? Yes, we have retained earnings. Now, retained earnings, there's a serious working here also. So we want to leave that one for now. And then when we come to current liabilities, we simply do the same. Now, this question is a fair question. It didn't have a lot of entries. As I mentioned, this is a tutorial question for understanding group accounts. Then we are going to advance to advanced questions. So there we go. So we simply pick these things the way they are. Boom. We paste in the answer sheet. Are you seeing? All these free marks, simply copy them and paste the way they are. Paste. You see? Copy and paste. Group accounts is indeed one of the easiest topics in the exam to pass. Copy and paste. Have you seen? So you're going to copy all these. We paste them into the answer sheet. Forget about the associate. This guy, we are going to deal with him later, is the associate. Forget the significant influence. So what do we do? Let's go to the whiteboard. We make our format and then we post our figures. All the free marks, we post them. Then we're coming to do the workings. Okay. So I made the ASFP already to save time. So there we go. We've got PPE, goodwill, investment associate, inventories, receivables, blah, 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 etc. We have all those. So the only thing you have to do now, we have to get figures and start pasting them here. This is such an easy topic in the exam. So before we go to the notes, paste the free marks. Now this will make sense as we go. So let's go. Let's paste our free marks. Okay. So we've got PPE. We said PPE, what do we have to do? We are going to get these two guys. Have you seen?
Yes.
220 plus 160 there.
20.
Are you see?
That's 3. Yes.
So 220. Now in our format, what do we do? In our format, we are simply going to paste 220. Have you seen that? We paste 220 plus how much?
160.
Plus 160 in our format. So what do? We bring, I'm going to bring figures here. Let me use a different color to help us. So we have open brackets, 220 plus
160.
160. Okay. Now leave it open. There could be something plus or minus coming. Don't close the brackets. Let's come to goodwill. Goodwill, there's a working here. Are you seeing? Just open brackets on goodwill and then just show that there's going to be a working. So I would even have to put in red to show there's going to be a working there. Okay. Anything else? What was the figure for inventories?
Inventories.
Inventories we had 384 plus 234. Are you seeing that?
234.
Yeah. How much do you have inventories?
618.
No, just paste. Don't add anything. Just paste 384.
Oh, 384 plus 234.
Plus 234. Receivables, what do we have?
Receivables 275 and 166.
275 plus 166. Okay, cash, what do we have?
42 and 10.
42 plus 10. Just copy and paste. Don't change anything. Don't add, don't do it. Just copy and paste. These are free marks in the exam. Let's go to equity. Equity, we said we always pick for the parent. You see?
The parent, yeah.
Yes, we always pick for the parent, equity. And for the parent, it was
400.
400. There we go. Yes, that's our figure there, 400. You see? Always for the parent. This guy, the 96, don't bring him anywhere near here. Okay, so we pick that 400 and then let's pick retained earnings. Retained earnings, we said, this guy, retained earnings, there's going to be a serious working. So ignore retained earnings. But we are picking the payables, these two guys. Because, have you seen? Copying and pasting. So what do we do? Let's go to our workings and then there we go. Yes. So equity. Now equity, usually you can simply open brackets. Share capital, open your brackets there and then put the 400. But because of experience, I can tell you even at the end it's going to be 400. Group accounts is a bit different. Even at the end, it's going to be 400.
Okay.
What I mean that group accounts are a bit different from published accounts. Published accounts, they usually share issues during the year, blah, blah, blah. But group accounts, it is rare that there are such kind of things. Usually if there's a change comes in at what? At share premium. But why am I opening the brackets? Just in case there's a note to do with the issues of shares. You come and either add and subtract.
Okay.
Yes. And then when you go to share premium, even share premium, we pick it the way it is. It's a free mark. See, we pick for the parent because the subsidiary is assumed to be in the parent's figures, to be included. Yeah. So there we go. Even this one we pick for the parent. You see. So share premium also pick this guy for the parent. So these guys, we pick them the way they are. So we pick for the parents 416 and then 457 and 343. You in the exam, just be relaxed and be faster. Not the way we are discussing, as we are discussing, so we won't be as fast as we can in the exam, but we hope it's going to be fast. So there you go, share premium. What do? We have the 16. Open your brackets, put your 16. Okay. Retained earnings, there's a serious working there. Just open your brackets and say working. There's going to be a working there. NCI, open your brackets. There's a serious working there. Loan notes, neo. We don't have anything on the loan notes. You see? Neo there. We've got nothing. We've got nothing. Payables, what do we have on payables?
Payables,
What do we have?
457 and 343.
457 plus 343.
343.
Leave it open. Either plus or minus something is going to come. Are you see? So you see, before you go to any note, before you go to see any note whatsoever, the first things you do, you first get the free marks. Are you seeing that? Because even investment associate here, investment is what you can even do when it comes to the investment associate. You can even open a bracket here if you want. You can open the brackets and then put the 3 something there, that figure. But because we're not sure, we don't know what's in the notes, so we're not going to put that figure here. If we read the notes, then I would have advised, say, okay, here, let's put a figure or not. Okay, sure. So now that you've picked the free marks, because just writing this format and posting figures can earn you something, a good number of marks.
A good number of marks.
Yes, so now let's quote the notes. Now let's quote the notes so that now we see how easy these things are. So we'll be posting as we will be calculating things. Okay, there we go. Those are our notes. So what do we do? Remember, every group accounts question has got a way you're supposed to make your calculations to make it easier for you. Number 1, start with the group structure. Always group structure. Okay, so how do you know the group structure? You come here. You see? This guy, Rorio guy, acquired how much? 80% of what the share capital. He acquired 80% of what the share capital. Have you seen it? So what are we talking about here? What we are saying that since I acquired 80% of this guy, at how much? At 160.
160.
Have you seen? And then also acquired, if you see,
40%.
he acquired at 160, and at the same day also acquired 40% of the ordinary shares of Comic at how much? At 70.
70.
When this date is very, very important, 1st of January 2027. You see that?
Yeah.
Because it's going to help us to calculate depreciation property. So you must know when you are acquiring and when you are reporting so that you know when to do the depreciation. Okay, there we go. We've been taught that this date retained earnings balances were 64 for the subsidiary and then 24 for the associate. That's good. So now from this information, we can work out what we're going to call our group structure. And our group structure really is such an easy working to do. It's an easy working. Let me work it out for me, then we're going to transfer it to our workings. Let's say, so how do you do the group structure? Simply bring it here. As we know, we said we first have got to remove the associate for now. So group structure, you bring the parent, this L guy, the parent, you bring him there. And then what do? You've got the subsidiary. What's the name of the subsidiary? It's H.
Hardy.
This Hardy guy. Then you've got the associate. The associate is who? Is Comic. Okay. Now we've been told this one acquired down what percent? 80%.
8.
You see? He acquired 80%. So this Hardy guy is 80% sub. You see? This one is 80% subsidiary, which means our NCI is 20%.
Is 20.
For the associate, we've been told it's 40%. We don't need to guess here. I see. That is our group structure. So what we even can do to make things easier, you even know at this date, the retained earnings for this guy was 64 million. Have you seen that? Those are the retained earnings. Then for this other guy, they were 24 million for this other guy. The retained earnings, they were 24. That is your group structure. That's how you do it. Simply pick these things and make that structure. So now let's go to workings and just paste that one. Then we can come back and now do other consolidation adjustments. This way of following workings in the exam is better because you know how things are flowing. Okay, there we go. So let's do our group structure. So our group structure is working number 1. So we have our working number 1. And that working, we are calling it group structure. Okay, so there we go. So the parent, of course, is what is L? So we've got L there as our parent, and then we've got H, who is the subsidiary, and then we've got L, C, who is the associate. So we've been told that the subsidiary is 80% sub, 80% sub, 80% subsidiary, and then NCI is 25%. Then this guy we know is 40% associate. And the retained earnings at the start we've been told. Now, when was this guy acquired? Remember, the examiner gives you professional marks for being neat in your way of answering. Put the date here. 1st of January. When?
20x7.
X7. See? At this date, retained earnings were how much? 64. Even this guy was the same thing. 1st January, X7. And the retained earnings at this date were?
24.
24 million. Kwacha. Okay, so that's our group structure right there. Have you seen? Now, the next thing you do, you work out the consolidation adjustments. Now, mukasangati umuri question notes, not number 1, not number 2, not number 3, not number 4. You work out those consolidation adjustments. That's the next thing you have to do. So, kwa makachana, so if you write consolidation adjustments, madam. Consolidation adjustments. Now, those adjustments, they're important because they're going to help you to know what happened at acquisition. Okay, so in this exam, when we talk about consolidation adjustments, what we mean, you're talking about things such as those fair value adjustments at acquisition, you know, yeah, such kind of things. That's what we're talking about here. So all those to my URP, Shanshan, those, bring them here. Must calculate to my consolidation adjustments. So you forget about those adjustments. So in this question, we have those adjustments. Alternatively, from the group structure, you can simply jump to goodwill, but I don't want to go there because I want us to follow step by step.
Or step by step.
Yes. But when you become efficient, you're going to be jumping all these steps. Just going from here, you know, goodwill is so. After goodwill is, then you're going to do it fast. But I don't want to jump. I want to take it. Okay, so let's go.
Step by step.
First things first. Remember, there's what we call investment in what? Investment in subsidiary. Now, in this question, we're not working out the investment in the subsidiary because we've been told how much this guy paid for. So the thing we have to do here, we have to work out the adjustments from the notes. So let's go to the notes and then we'll work them out. Then we come back here. Okay, so there we go. That's our question. Now we can go to our notes. Okay, what have we been taught? Note number 1. What is it saying?
On 30th November 20x9, L'Oreal sold some goods to Hardy.
Okay.
Cash 2 million. These goods had originally cost 22 million and none had been sold by the year end. On the same day, L'Oreal also sold goods to Comic for cash for 22 million. These goods originally cost 10 million and Comic had sold half by the year.
Okay. Have you seen that? in this note, the keyword here, the keyword is this guy, Rore or Sword. Have you seen? Who is Rore? Rore is the parent. Have you seen? When the parent sells, do not bring whatever the parent sold more net asset list at acquisition. Are you seeing? Do not. What you're going to do, you're simply going to debit group retained earnings to reduce it to show that the parent should not recognize that money from the subsidiary. And then also reduce what? The group inventory. It's important to remember that. So let's work it out. So what we could have done here, the parent sold here to the subsidiary. So how much was how much did the parent sell? They sold goods worth 32 million. Are you seeing that? But these goods were worth how much? 22 million. Meaning the parent made a profit of how much? Of 10 million. So the 10 million here, you are going to debit it in the group retained earnings to reduce the retained earnings by 10 million. And at the same time, you are going to go to the group inventory. Have you seen it? And reduce by 10 million. This is where the gentleman from Facebook was asking, his name is Paul Manda Jr., how to calculate and realize profit. So now, Paul Manda Jr., here is your time. Here is what you're asking. So here what to do, now let's do the working. So I'm going to work this one out here, and then we're going to go to the answer and just post it. Okay, so what we do here is this. What we have the parent is selling. When the parent is selling, he sold how much? The goods were, the price was 32 million.
But they are worth 10.
They were worth 22 million. Which means the parent made a profit of how much? Of 10 million kwacha. Now, this 10 million kwacha, what you do, simply go and number one, debit the group retained earnings. And then number two, credit inventories, the group inventories to reduce it. Have you seen? Group retained earnings, debit by the 10 to reduce the amount, the profit they made. And then go to inventories. Also, inventory, what do you do? Also do the same. So let's go to inventories and post. So we go to, that's working number one, character number 12, and realize profit. So we go to our answer, to our SFP there. So what do we do there? We are dealing with it and realize what? And realize profit. So now there we go. And realize profit. Or intergroup transactions, whatever it can be called, intergroup transactions. Maybe let's call it intergroup transactions to make it more general. Okay, intergroup. So intergroup here, Paul Manda Jr. So intergroup. So what do we have? We've got a parent here sold. So I'm just going to bring this guy here. So parent whose role was sold. So the cost, the fair value, the price was how much? Was 32 million. He sold that. The CV was 22. The price was 32. So when he sold, he made a profit of 10 million. Now this 10 million quarter we said, number one, what to do, debit the group retained earnings and then credit inventories for Twachland. So what do? You go to inventories. Where is inventories? There you go here. Remove that 10. Because you cannot buy from yourself. So you get money from one pocket to put into the point of sale. So what are you going to do? In the group retained earnings, remember here, where we said there's going to be a CS working on group retained earnings here.
Retained earnings, yeah.
Already we know the opening balance, that figure they came with, we're removing a 10. So we're not going to bring it, we're going to do it in the working. So what do we do? There we go, that working is done. Now look at it this way. this thing did not just end here. This guy went further. He also sold to the associate. Now, when the parent sells to the associate, the treatment is a bit different. See, we've been told on the same data, this guy is sold to the associate. Goods worth how much? Goods worth 22 million. But these goods originally cost how much? 10 million.
10.
Have you seen? So what do we do here? We know the selling price was 22, the parent sold, but the initial price was how much? Was 10 million. So the parent made a profit of how much? Of 12 million. Now see, we've been told, and the comic had sold half by the end. So the subsidiary, the associate here also sold half. Have you seen? Meaning that from this profit of 12 million, half was sold someone, half has gone, has been realized. So that means we are not going to reverse the whole 12, no. Only half of 12, because half was sold to the outsider, which is okay.
Yeah.
Have you seen that? Half of those goods were sold to the outsider. So in this context, what do we do? What you are going to do here is this, Mr. So to ask so to send the 12 million here. Remember, as we do not control the associate, the only thing that we have is significant influence. And the influence that we have is how much? Is 40%.
40%.
So because we know that half has been sold, we're going to multiply this figure by half. Have you seen that?
Which
12 million multiplied by half,
which gives us 6.
Yes, which gives us 6. Now this 6 we are going to multiply by 40%, the influence 40%. That we have. Because we do not control everything. Which gives us how much there? Which gives us 2.4 million. Have you seen that? So to make it easier, it could have been done something like this. Could have been, let's say it would have been 22 minus 10 multiplied by what was sold to the outside as half, then multiplied by how much? By 40%.
By 0.4.
To give us
2.4.
2.4 million. That could be the other way, the other layout, alternative to this guy. We could have done that way. Now the question is, where are we going to take that 2.4? Are you seeing it? The 2.4, we are going to debit group retained earnings. The parent will not get this money. So one, debit group retained earnings by 2.4. And then in the double entry, hello?
Now, I wanted to, why was the parent, why won't that be attributable to the parent?
The reason is simple.
Is it because, it's the subsidiary that sold to the associate?
No. Here what's happening is that, see, the parent sold to the subsidiary. Here the parent sold to the subsidiary, goes worth this much. Have you seen that? And they are costing this much. Now at the same time, on the same date, the parent also again sold to the associate. You see? The parent again sold. Here. You see? So it's like the parent, you know, when you are the parent of the company, remember the control principle.
Selling both to the subsidiary and the
associate.
The associate.
Now, why do we remove that money? Because you know the control principle. The substance of control is that when you control, it means you own what they have. Are you seeing?
Yeah.
The purpose of group accounts is to report their financial statements as belonging to one entity, as a single entity, not as separate entities. So these ones are the parent and the subsidiary, they are married. Are you seeing?
Yeah.
There's no way. It's like you have a wife. Now your wife, you put money together in the same account. You've got a joint account with your wife. Are you seeing? Huh? And then your wife tells you that, my husband, you are so nice. I want to buy for you a present because you've worked so hard at home, teaching our children when I'm not around. You over the weekend you sacrifice. You stay home, so I'm going to pay to buy for a present. You say, thank you very much, my wife. But what does she do? She goes to your joint account and withdraws the money and pays you. She wants to pay you.
She wants to pay you.
Where is the money coming from in the first place? She's getting the money from the joint account.
The joint account, yeah.
Have you seen? And then she pays you. So you, when you get this money, I've gotten paid. Thank you so much, my wife. What do? You take it to the bank and deposit again. Or do you say you've made any money?
No.
No, because in the first place, the money was yours.
The money was yours, yeah.
Are you seeing, huh? So your wife goes to your joint account and gets money and pays you for being a good husband. She's not giving you anything that doesn't belong to you. The money belongs to you already. So if you recognize that money and say, yes, I have money. What will happen if you get that money she pays you and put in your account? Are you going to have more money? You won't have any more money. You still have the same amount.
You won't have any money.
If your joint account had 100,000, she gets a 10,000 and pays you. Mwasha 90,000 in joint account. You see? Now you receive this 10,000. What do? You take it to the bank and deposit it in the bank. Have you seen? When you add, the two will go back to how much? 200,000.
It comes back to the same.
Are you seeing? Huh? That means there, your wife has not given you any money. Because in the first place, that money was yours. But now, where your wife gets money from somewhere and pays you, that means now you have money. Because if you go and put into your joint account, money will be more. Because she's gotten money from somewhere else, not from your joint account. Are you seeing? Huh?
Yeah.
So it's the same thing with the associate, with this question. The associate here had sold these goods to a different company somewhere else. Are you seeing? So that the profit they are going to make on the different customer is genuine because it's going to increase the overall money here. Are you seeing?
Yeah.
Yes. But if they did not sell anything, it was just going to be the same thing. Is that okay?
Yeah, that's fine.
Okay. So there we go. So that we can get this one. Now, we said the 2.4 goes to the group retained earnings. Double entry, we are going to credit the what? Investment in associate. Have you seen? This time around, we're not creating the investment. We're not creating the inventory, the group inventory. No. We only create the group inventory if it is the subsidiary who bought from the parent.
Who we sold the goods to.
Yes. But for the associate, we simply credit what? The investment the associate to reduce the associate's investment. Have you seen?
Yeah.
Yes. So that's what's going to happen. So there we go. Our working has been done there. So what do? You simply go there and post. The 2.4 reduces our inventories. Have you see that? So you go to SFP there. Quickly, your inventories, what do? You reduce your inventories by how much?
Yes.
By 2.4. Where the inventories? Yes, there. So you're going to reduce your inventory figure by 2.4
again.
Now, that one, let me mention that my one hope is that I don't know if you're okay at this stage before you go far.
No, I am. So the treatment of unrealized profit is different between the associates and
No, the 2.4, yeah, the associate, we don't reduce the 2.4 from the inventories. We reduce from the associate here. We are coming to reduce here 2.4 from the associate. Coming to reduce the 2.4. We are coming to reduce it here, the 2.4. That's where we are coming to reduce it from. And then for inventories for the parent, we're not going to touch it. No, we won't touch inventories. Yes. Okay, so let's go. So that was for the associate. It was simply 22 million minus 10 million multiplied by 1 over 2 the half multiplied by 40%. And then we have how much? We have our 2.4 million, which we are going to debit our group retained earnings and also reduce the investment
in the
associates. Okay, let's go to note number 3. So group accounts really is very, very easy. It's very easy to nail down. Okay, let's go to note number 2. Note number 2 says on 1st January 2027, who owned the property?
On January 2027, Hadi owned some equipment with owned some items of equipment with book value of 45 that had a fair value of 57. These assets were originally purchased by Hadi on 1st January 2025 and are being depreciated over 6 years.
Yes. Okay. So some items of equipment with a book value of 45. See, the book value was 45. But what was the what was the fair value?
57.
57. You see that? These assets were originally purchased by Hadi on 2025. Have you seen? So this is the date. This date is important to help us calculate the excess depreciation. Whenever there's a gain in the asset's value, we have to charge deep to show the true value of the asset. Have you seen it? Useful life, how many years?
Useful life, 6 years.
6 years. Are you seeing that? Okay. So here, this asset was purchased on 1st January 2027. Have you seen it? But when was it originally purchased? Originally purchased when? In 20x5. Have you seen? The asset was originally purchased in 20x5. Have you seen? But in 20x7, the fair value changed from 45 to 57.
To 57.
Are you seeing that? From 45 to 57. So here, what do we do here? Here we are going to work out a simple calculation, and we're going to do something like this. Okay, there we go. So we've got, remember the fair value adjustment of a bomba. The fair value adjustment is a very, very easy calculation, which we must be able to put the way it is. So what we have the asset value of 57. So simply say fair value. The fair value was 57. And then the CV was 45, which gives us a gain of how much? Of 12.
That's true. Yeah, 12.
Have you seen that? Unfortunately, this 12 is not a true gain. Are you seeing? Why? Because this asset was purchased when? In 2005.
28. So there's some depreciation.
Are you seeing? But when are we preparing our books?
20.
When are we reporting?
Just a minute. Let me just look at the.
We're reporting in 20x9.
20x9, yeah.
20x9, that's what we're reporting. So if this asset was purchased in 2005, how many years to 20x9?
4 years.
No. We've got 20x5,
Or it was purchased in 20x, so it's 2 years.
20x7, 20x8, 20x9. 1, 2, 3, 4, 5. January 1, 20x5. Have you seen?
January 1 to January 1 to January 1 to January 1, 20x5 to 31st December. That's 1 year.
Okay, so how many years are we talking about here?
1st January. So 5, 6, 7, 8. It's 5 years.
Are you sure? Are you sure?
Yes. Yes, it's 5 years.
Are you sure it is 5 years?
Yes, it's 5 years.
Okay. Now, what I want us to discuss is not 5 years. What I want us to discuss is when was it? It was revalued when? 1st of January.
20x, yeah.
Have you seen? That is the most important part. The date of fair value. Have you seen?
Yeah.
Important. So 20x1, 20x January. So at 1st January 20x7, how many years did it remain with?
How many years was it?
So from 20x5 to 20x6, 2 years had passed. Have you seen?
Yeah.
Then 20x7 year number 3. So from 6 years, that means we're remaining 4 years. Have you seen? From 20x7, 20x8, 20x9, 10, they are 4 years. But we're reporting when in 9. So this asset has got how many years from 20x7? Has got 4 years remaining.
4 years.
Have you seen it? But from the 4 years remaining, we're only going to charge deep for how many years? For 3 years. For 20x7, 20x8, and 20x9. The other year, we've not reached there, the 10. Are you okay?
Yes.
So we have the 3 over 4. Deep we're charging 3 over 4. So what do? We are going to multiply this 12 by 3 over 4 because it was revalued by 20x7, meaning that we needed to charge depreciation at this date when it was revalued in order for us to be prudent. What we are trying to establish is that the gain, this 12, should also suffer depreciation. Why? Because if we don't charge depreciation, it means we are undercharging depreciation. We thought the value was 45,000. Have you seen? So we've been charging deep based on how much? On 45,000. Can't this value 3 years ago increased from 45 to 57?
57.
So deep has been undercharged on this asset. So what we want to come up now, we want to the gain also the 12 to suffer the deep, so that we report the true value of the asset. So when we get 12 multiplied by the depreciation is how many years are we charging deep? 3 years, huh?
3
From
years.
the total remaining life of how much? 4 years.
4.
How much do we have when we do that?
So that's 12 by 0.75.
What do we have?
9.
We have 9. Are you seeing, huh? So that means the depreciation is how much? How much is our depreciation figure?
How much is?
How much is our dip?
That's the 9 itself.
Okay, the 9. Huh? Now, this 9, as you know, is going to reduce debit our group retained earnings, to reduce it. Are you seeing? Huh? So what this means is that the true gain and that we are going to take to PPE is how much? Is it 3?
Is the 3. The
9 minus 12. We have 3. So meaning this year, our figure for the SFP is only 3. So 3 is going to increase our assets. 9 is going to reduce our profits because 9 is depreciation. You see the importance of charging dip. If we did not charge dip for the past 3 years, excess dip, we would have increased our assets unnecessarily. Are you seeing? Huh?
But because we are reporting a higher figure of assets,
yes,
we are not charging depreciation.
Have you seen? Huh? So we've been so from 20x5, from 20x7 when this was valued, they did not charge depreciation. 20x80, no dip. Have you seen?
No dip.
So we have now 20x9. So what do? We are correcting. So this dip is called excess depreciation, extra dip from 20x6, 20x7, 20x8. So 20x7, 20x8, and 20x9, which is for 3 years, how many? 3, 3, 3, yabana shinga, yabana 9. So this 9 has got to be reduced, everything, from our group retained earnings. But this 12 here, the 12, this figure 12 here simply goes straight to the net asset list at acquisition. Yes. So the adjustment itself, you simply get the way it is and put per acquisition. Have you seen that? But the movement, the depreciation and the asset, now they are the ones that are going to show myself to show now the true value of what has happened. Why are we doing this? At acquisition, we're putting the 12 the way it is because we want to show the true value of what? Of goodwill. Are you seeing that? As you know, DIP is a non-cash item. Are you seeing that? So what we want to show, very good, we're going to put the same 12 the way it is, the adjustment, to show the true value of goodwill at acquisition. Because when assets gain value, goodwill loses value. Are you saying?
When assets
gain value, goodwill loses value. What this means that if you know what goodwill is. I did a video on goodwill on Facebook. Please watch it. It has explained goodwill very much. You're going to see why goodwill loses value when assets gain value. So what do we do? Let's go to our working there and simply post it. Are you okay at this point?
Yes, we can proceed.
Remember, we're still doing the consolidation adjustments. So what do we do? We go to our fair value working number, number 3 akanono. Fair value adjustment. So what we said here, the fair value figure, we were told the fair value was how much? It was 57. And then we've been told also, since the fair value was 57, the CV was 45. And then we've been told that the gain now, that means our gain was how much? Was 12. Now this 12, we multiplied it by how many years of DIP? 3 over 4, which gave us how much? Which gave us 9. So 9 is excess DIP. Excess DIP. And what did we say? We said that this 9, we are going to debit the group retained earnings. Have you seen that? That means the only real value, the only real gain for 20x9 is 9 minus 3 minus 12, which gives us how much? 3 million. So this 3 is going to debit what? Debit PPE. To increase the PPE by that 3.
That amount.
Yes. Now, how about the double entry? How is it going to be? The 9 goes to reduce the group retained earnings, and then the 3 goes to increase our PPE. It means we've already done our double entry. Because if we had to put the 12 PPE, we would have still come and reduce the 9 for PPE. Are you seeing? To bring it to 3. So when we do 3, it means we've already done the double entry. We've already reduced the 9 from the 12, from the PPE. That's the idea.
Okay.
Remember, the gain is 12. So if we get this gain and put PPE, that means we're going to bring the 9 PPE and reduce it so that the true value remains at 3. So to avoid all those unnecessary workings, what we've just done is okay. We've
Just
just worked it out
carry
at once. Just carry the true figure and post it there. So what do? We go to our PPE and simply do what? Simply increase the 3 in our PPE. Okay, so what do? We say PPE plus how much? PPE plus the 3.
Plus
3. That is the true value. Okay, next, let's go to another note. Let's go to another note. Okay, there we go. So we have another note. Okay, see these notes, they are really nice notes. See, we've got now NCI. Okay. We have NCI. We've been told group policies to measure non-controlling interests at fair value, at acquisition at fair value. Is it? The fair value of the non-controlling interest in Hardy on 1st January 2027 was calculated as 39,000. This is a free market. They've worked out the NCI for you. Are you seeing it? The fair value. So just pick this figure and add it to goodwill. Have you seen it? Okay. So we are going to add this to goodwill.
Okay.
Yes. We are going to add that one to purchase price so that we come up with a goodwill at acquisition.
Come up with a goodwill.
So we are going to show that. Then note number 4, does it say cumulative impairment loss on recognized goodwill is how much? 15.
15.
Okay. Okay, so now these ones now we are okay. So what do we do? Let's do the work now. So let's go down to the calculations. We're going to do the net asset list. Now, the net asset list is working number 2. After you've done the consolidation adjustments, you now work out the net asset list. Okay. So there we go. Working number 2. Now the real 2. Are you seeing her? We say net assets. Okay, let me just say working number 2. You know, I love group accounts because it makes sense. Working number 2. Now working number 2, what do we call this? Working number 2 is simply the net asset list. Are you seeing her? It is simply the net asset list. Now we've got what we call at acquisition, and then at report, and then at what? At PAP, post acquisition profit. And this one never changes. That's the beauty. Share morphine all the time. You can even guess. We've got what you call share capital, share premium. We've got our retained earnings. We've got our fair value adjustment. We've got URP. And then we've got, no. Before URP, first let's move our dip. Let's remove our dip. We've got depreciation. Then we've got our URP. And then sometimes we've got things such as brand. You see? Here. But for the purpose of this question, we don't have a brand, so I'm not going to include it. So there we go. What do we do? Let's put our figures there. Share capital. What was the share capital at acquisition? Now here, the net asset list. One thing to remember is that you only bring things for the subsidiary here. Are you seeing? Huh? Only bring figures for the subsidiary, on the subsidiary. You want to show the true value of the asset. Are you seeing? The true value of the assets at acquisition. Are you seeing? Huh? Okay, so there we go. What was the assets for this guy? Now we know. One thing we know is that the subsidiary had how much? When you say net assets, we're not talking about inventories, we're talking about reserves. We're talking about this guy, equity. We're talking about share premium. Are you seeing? And retained earnings. Are you seeing? Now, if you've noticed, These figures have been given to us when? At the date of report. The 96, the 3, and 128. At the opening date, we were told that the retained earnings for a subsidiary was how much? It was 164. Somewhere here. It was 64, yeah, it was 64.
It was 64.
Yes, so what do? We pick those figures and we paste them by NA. It is really such a beautiful, beautiful question to learn group accounts. So there we go. We have our share capital at acquisition. We had 96 at report, and then we don't have any other figure that we were given, meaning that even at acquisition, they're down much? 96. So bring 96 also there. Are you seeing at report? At acquisition share premium, what did we have? We've not been told anything apart from a 3. Yeah? So we're going to assume they are day 3 here. We're going to assume they are day 3 at report, because even at report they are day 3. So mean nothing changed. Even at acquisition they are day 3. Retained earnings, we were told they came with how much? With 64. But now they have how much? They have 128. Of which, when you less, you're going to have something called how much here? 60?
128.
128 minus
64, sorry.
64.
64. 64 again, sorry, yeah, 64.
You're going to have 64 there. Here you have new. Here you have new. Okay. Fair price adjustment, what were we told? We were told that the true adjustment was how much? Was 12.
12.
Have you seen that? At acquisition. Are you seeing?
Yeah.
Now, normally, I would like it to put it this way. Remember, there was if we want to duplicate the answers, we'll simply bring the 12 also here. Are you seeing? And then
We'll simply,
if you want to duplicate answers, we're going to bring the 12 here. Now remember, it won't work because in this case, who was selling? The one who was selling, then what was the dip? The dip was 9. If we bring the 9 here, we don't bring dip at acquisition because you're just acquiring, you don't use the asset. So here we say none. We bring our 9 there. Have you seen? URP, nothing, nothing. Why? Because when the parent sells, you don't bring URP here. You only bring it when NA, when subsidiary sells. So no URP when parent sells. So what do we do?
okay.
There we go. Here we are listing. Yeah, these ones are negative balances. So what do we do? We've got 96 plus 3, 99, plus 64 plus 12. How much is our total? 175. Do you see that? But 175.
96, 3, 64, and 12. 175, yes.
175. Now, remember, this figure is going to be used to calculate our what? Our goodwill. Are you seeing? And then what we're going to find out here, this figure is going to be used to calculate our what? Our NCI and our group retained earnings. Yes, so if we bring this figure here and remove it from here, how much is our post-acquisition profit?
55.
Are you sure 55 is our post-acquisition profit?
Yes, 64, take away 9.
Yes. 55.
Yes, 55.
I love making up because meaning that I'm share group retained earnings will simply come and copy and paste this all line. We'll simply come and copy and paste this all line here. Copy and paste by the answer sheet. By group retained earnings. We'll simply come and copy and paste. So I love this one. So Mamona, this one will be used to work out the NCI. So meaning that why do we say it's going to be used to work out the NCI? What we mean is this. What we mean that as a parent, we only control 80%. So 80% of 55 belongs to us, the parents. Then 20% of this 55 belongs to the NCI, what we don't control.
NCI.
Have you seen? Yes.
Yeah.
So that means in our group retained earnings, we are simply going to do what? We're simply going to add 80%.
Our share.
Have you seen the share of what? Post-acquisition profit. Then the NCI 20% is going to be shown that it is not ours.
It's not ours.
It does not belong to us. Are you see?
Yeah.
So there
That's
we go.
Now in the calculation of goodwill.
No, this one 80% is the calculation of group retained earnings. But goodwill was simply going to use this one. Goodwill, just this one, goodwill.
The 175.
Yes. So let's work out our goodwill calculation quickly before my battery goes. So my laptop is down and we don't have power to them. So we are working number 3, goodwill. Okay. Purchase price. What was the purchase price?
Purchase price.
It was 160 million, not so?
Just a minute.
How much was the purchase price from the question? We are told in the question it was 160
share
million.
capital 160 million.
160 million. What was the NCI at fair value being told was 39? 39.
64.
No, NCI was 39. From the question we've been told.
Oh, okay, from the notes, yes.
Yes. When we add the two, how much do we have?
199.
199. We remove net asset lists at what? At acquisition. Net asset acquisition. Huh?
That's
what
the 175.
The 175. You remember that one from goodwill?
Yes.
So we have how much here?
So that's 25.
We have 25. Are you sure?
Yes, it's 25. 24, sorry. 24.
24.
24.
So we have our 24 there. Now remember, we've been told in the note that goodwill was impaired. So this is our goodwill at acquisition. Now we've been told goodwill was impaired. So just the impairment.
Yes.
How much was the impairment? From the question.
Look at the notes.
Remember in the question we were given the impairment?
Impairment 15.
15. Okay.
15. The last note.
Oh, not your last time. Okay, there we go 15. Okay. So we remove that impairment from our question. Okay, so we remove our 15. Now that 15 is our impairment. So what we do, remove the 15. The goodwill impairment of 15. So now we've got it. The goodwill at report. What is going to go to ISFP is how much is 12?
9.
Is 9? 9.
Yes.
Are you sure? 9.
Yes.
9. This guy goes to the SFP. NCI, working number 4, non-controlling interest. What do we do? Remember, post this one to SFP. NCI, what's our NCI? At fair value. So NCI will go to the fair value. We say NCI at fair value being told was 39 in the question. Have you seen that? Then we say NCI percentage of PAP post acquisition profit. So we're going to say 55 multiplied by. Remember the post acquisition profit, the figure. Have you remembered this figure?
The figure in there?
Here, 55 for NCI. This figure,
yes.
You see? So now we're getting the NCI now. Remember this guy.
Okay,
20%
so
is for NCI.
20% of that.
Yes. So what do we do? 20%. So we're going to say 55 multiplied by 20%. How much is that? Let's say my bat is about to die. That will appreciation. Let's go. But not
11.
11, huh? Okay, so we have our 11 there. When we add, how much do we have?
Which ones are we adding?
When
I
we
can't
add this gap and this one, we have 40, 50.
50,
Well, we remove the
39
impairment
plus
loss. It also should be able to cover the impairment loss. What was the impairment loss? It was 15, huh?
15.
Multiplied
So
by
the guess
20%, which is how
so
much?
15 by
Which is the 3.
3.
So our NCI at report is how much? 47.
Okay.
AMSFPE. So let's post quickly. Let's go to SFP and post. So our NCI, where is our NCI? Here. We have our 47 by NCI. Goodwill, how much is our goodwill?
Goodwill 9.
9. Okay. What we do, let's do important looking at group retained earnings. Group retained earnings, working number 5. It's just simply say per question, huh? Per question. Per question simply means the 12 balance figure. For the group, what was the retained earnings for the parent? We've been told the question, huh? It was a lot of money for the parent.
Retained earnings 278.
For the parent?
278.
Oh, there we go, 278. Okay, yeah, there we go. So what do we do? Come on, come on, come on, come on. My bat is getting low. I hope it won't go off. So we have the parent, we've got the subsidiary, and we've got the associate. For the parent, we have 278. For the subsidiary, we have 120. How much? I'm moving now, failing to write properly because I'm running against time here. We've got 128. For this associate guy, what do you have? How much?
Associate, we have 97.
97. Okay, so we've got opening balances. Huh? So what do we do? Remember what we said? We're now coming to copy and paste this one here. Copy and paste this one, the pub. So we have at acquisition, we've got the depreciation fair value adjustment, then we've got how much? We've got excess dip and we've got 55. So you copy this one and paste it here. So what do we do? We're going to have acquisition. Huh? At acquisition, we've got 64. Here we've got 24. Then we've got dip. Here we've got 9. Here we've got new. So what do we have? We have 55. There, how much do we have? How much do we have?
24, just a minute. That's 97 plus 24. 121.
How much?
121.
73. 97 minus 24 minus.
Oh, it's subtracting.
We're getting the difference here. Yes.
Okay.
Okay, so what do we do?
73.
We are going to get the group share of what? The group share of this, 80% of this guy. Have you seen that? So we're going to have what we call share of profits. So share of what? Share of profits. So we're going to say from A, from sub, we're going to have 55 multiplied by 80%. How much is that?
80%. 55.
How much is that? Please.
44.
44. Then 73
by 0.8
multiplied by 40%.
By the associates was 0.4.
How much do we have?
80.8.
How much? 29.2. 29.2.
Or 73, also and then 77.
29.2 for the associates. Okay.
Yeah,
and then what do we say? We remove the group, the URP. You remember? We're going to remove the 9, remove the 9, and also we remove the 2.4. You remember 2.4? We're going to
Yes.
move the 10 also here, this 10, and also this 2.4 from the group. So we
10,
move now to
2.4.
RP. So we have URP total, not quarter, 10 plus 2.4, which is equal to 12.4 to Afuniamo, and then deeper, excess deep.
Excess deep.
How much was it? 9.
9.
So what is our group retained earnings?
Group retained earnings.
No, the PAP was 10. It wasn't 9. It was 10. It was 10, not 9. It was 10. For this one, it's 10. It's 10, 9.
No, 10 is already there.
It was 10. That was 10. Not clear for me. Not 9. 9 not with Piamo correct.
Not 10, not which. 10 and 9 are both there. So the 10 is here. The 10 is in the 12.
Oh, the 10 is there. Oh, yeah. Okay,
Yes.
good. Okay, thank you. Yeah.
The 10 is in the 12.
Okay, so now how much do we have? How much our profit there?
29 minus 12.4. And the 9.
9 atufumia moyo hapo.
So no need, not 9 direct mamo.
No, tatufumia twice. If we remove it, we actually remove twice. Have you seen here?
Yeah. So it's 60.6.
No. We've got 278 minus 10 minus 2.4 plus 44. 278 plus 44.
Oh, there's 278. Okay.
Plus this guy, then minus 12.4. How much is that?
12.4. 338.8.
Huh?
338.8.
Okay. Now remember, group also has got to suffer the impairment loss. Have you seen that? The group has got to suffer the impairment loss. So remember, group what?
So that 15.
Group what?
So that's depreciation.
Impairment loss. So it was 15 multiplied by 80. How much is that?
0.8.
12. Huh?
0.8. Yes, 12.
How much do we have now here? How much is our figure?
326.8.
326. If you get there, SFPE. So immediately we go and post SFPE. How much? 326.8 as our retained earnings here.
Retained earnings.
Working number 320. I'm writing fast because of my battery. Yeah, 326.8. Investment associate. Working last. How do you do the investment associate?
Investments in the associates.
Working number 6, huh? Investment in associate. Simply bring the purchase price, huh? What was the price we're going to be first here? What was the price for the associate? 60 million? How much?
60.
Are you sure?
Just a minute.
How much was the associate purchase?
70.
So 70. Okay, 70. Then we remove from the 70 the share of profits. Share of profit. How much was the share of profits?
Share of profit.
Share of PAP. What was the PAP? The PAP was 55. Multiplied by how much? Multiplied by 60%. No. We control 40%, they control 60%, the associate. Them.
Oh, the NCI.
How much is that?
That's 33. 33.
If you multiply
60% of the 50.
70 by, if you multiply 70 by 40%, how much?
70 by 40%.
Yes.
28. 70 by 40%. It's 28.
Okay, investment associate, you've got 70, then we've got share of post retained reserve. That was our working number 4. We worked it out, it was 73 multiplied by 40%. Remember? Which was how much? Which was 29.2. To achieve
29.2, yeah.
Hey, just speak it. Why they bring the? I should not tell you. We are bringing that 73 multiplied by 40%. I'm even getting confused because the battery and the rush might just cut. Okay. Yeah, kappa. So there we say 73 multiplied by 40%, which gives us that figure there. And then we remove that one, URP 2.4.
2.4.
What's the investment associate? 96.8. Because here impairment here could do Taisa associate. Taisa exists, so still bring the same 96.8 SFP. This is the question here. So we are done. 96.8 investment associate.
So that's the investment.
So what you do simply now make the totals. Put number. We can so number is more pusher. That's how this question ended. Okay, thank you very much.
Okay, so you post this on Facebook?
I'm going to put it on Facebook. There's a gentleman, Paul Manda Jr., he wanted to not do any raise profit. So I hope it's going to help him. Yeah. Thank you so much, Mr. Mbanga. We hope to do another session. So we're going to do now a more advanced question now from this one.
Tomorrow?
Yes, hopefully tomorrow, because tomorrow I'm engaged. I've got other commitments.
Oh, okay. The whole day?
Yeah, I have commitments tomorrow the whole day. Tomorrow is Sunday.
Yeah.
Okay, tomorrow I'm busy. Yeah. I have meetings in the morning, and then in the afternoon I've got other commitments. Okay, thank you very much. You have a lovely night, and I must say, please go and watch the video on Good Look from Facebook.
Okay, no, I will.
Okay, sure, thanks.
All right, thanks.
Bye-bye.
Good night.